Good afternoon, my name is Mario Becker. I'm the founder and CEO of Das Family Office, a Singapore-based multi-family office. In the following video, I give you a summary of the second quarter event and what happened in the first half of 2021 in global financial markets. I hope you find it useful. Yeah, hard to imagine. We've already reached the second half of 2021 and 6 months of financial market events are already behind us. And what can we say? The second quarter more or less followed the patterns of the first quarter. That means it's been a really good year for global equity markets, which realized returns that we typically don't achieve in a whole year. In many cases, like US small caps or global value small caps, we achieved returns above 20%, which is about 3 times the usual return for global equities, which are more in the range of 6 to 8%, sometimes a bit more. Chinese and Japanese stocks were the exception because they were flat or down for the year. And especially China was disappointing because we expected some kind of fireworks, let's call it this way, because on July 2nd, the Chinese Communist Party celebrated the 100th anniversary of its creation, its foundation. But it looks like the Chinese Central Bank is immune to such excitement because they haven't been producing more liquidity for the markets, and Chinese equities have basically peaked in February. Ever since then, they've been going down to sideways. We've just about avoided a bear market so far. What is interesting in the second quarter, the so-called quality or stay-at-home stocks, they saw a recovery. And this is quite interesting because in the first quarter we discussed whether this is a return of the value markets and whether investors should shift away from quality and stay at home, specifically also the Nasdaq 100 darlings. But as it is, in the second quarter, especially towards the end of the second quarter, it appears that there's a sentiment that the Delta variant of the COVID virus could make the economic recovery a little bit slower and thereby not produce as much inflation and thereby support the companies that tend to do well in any market environment, be they an economic recovery or be it an ordinary economic environment. So it's quite good that we told our clients early in the year not to make such a switch and stick to their investment styles to avoid that you'd have to buy these stocks at higher prices, which is now the case. Then other, let's call it risk assets, be they high yield bonds, be it tier 1 capital, be it the more aggressive segments of emerging market bonds, they also did quite well this year. So far this year, emerging market bonds, which are a bit of a hybrid between safety and return, they've seen a weak first quarter, but they've recovered very well in the second quarter and are now typically up for the year. That leaves really only the safest investment grade bonds, government bonds, US Treasury underwater, especially if they are long duration, long maturity government bonds. These are down almost 10% for the year. The 10-year Treasury, which traded as high as 1.75, is now only at 1.36. And I think the result is really here, or this is the result of the fact that the Delta variant is changing the discussion. And a lot of investors who were quite convinced that we would see long-lasting inflation seem to have changed their positioning and have bought back a lot of the bonds. Even if at 1.36, even at 1.75, we can say that this will not protect your purchasing power because inflation is now running at about 3 to 4%. And many inflation preachers are now saying this is a lasting phenomena, this will not change so soon. But that remains to be seen. It looks like the US Fed is having a different opinion. And also the bond market, if it now prices the 10-year Treasury at 1.36, seems to be of the opinion that inflation may be a temporary issue. In as much as markets have done well, our various portfolio building blocks have done well. And I can happily say that our clients are making a lot of money, whether or not they're following their balanced approach of having equity and bond portfolios, quality stocks, quality bonds that is, or the clients who follow a high yield strategy, a globally diversified high yield strategy. They're all making good money this year. One building block I'd also like to highlight is our building block B15, which is the PIMCO Income portfolio. This is a portfolio we've been talking about for many, many years, and clients were generally happy with it. But last year the portfolio was a big disappointment, which is why we've been discussing with many clients whether or not to switch out of PIMCO Income. But similar to the discussion earlier in the year, whether to switch from stay-at-home stocks into value stocks. And we said, no, you better stay the course, stay with a decided strategy. It was good to hold on to PIMCO Income because whilst US Treasuries are down for the year, PIMCO Income is actually up for the year. So it was worth staying with this manager. And yeah, it basically also shows that overall, while we may be quite boring in our approach in that we say stay the course, hold on to the portfolio that you've created, stick with the quality. I guess that makes us quite different from the average private bank, but it's working, and it's working for our clients, and that's why we do it. Yeah, and most of all, I think it's also important to understand that these quality balanced portfolios typically beat inflation. So in the past many decades, such portfolios have delivered returns of somewhere between 4 to 7%. If they had a higher equity tilt, they could have delivered more than 7%. But pretty much all portfolios could beat inflation. The long-running inflation over the last several decades in industrialized nations, in the US, in Europe, has been around 2%. So all of these well-balanced, diversified portfolios could beat that inflation. And even if this currently 3 to 4% inflation rate would be lasting a little bit longer, not just a couple of months, we can honestly say that our portfolios should beat that inflation and maintain the purchasing power of our clients. So we're really not worried about inflation. I can honestly say that. Based on that, I would also urge you not to look into exotic investments or untested investments. I see a lot of people talking about all sorts of commodity ideas, then naturally crypto. There are a lot of things that are thrown at you at this point in time, and I would suggest just ignore it. It's noise. It's not worked in the past to dabble into things that are not tried and tested. So why do it now? Just stick with the quality that's been working, and it will most likely also continue to work. One slightly more personal element I'd like to add this quarter is the fact that on May 5th, David Swanson died. David Swanson, I would consider a mentor, although he never got to know me. He managed the Yale University Endowment, and I consider him a teacher through the books. He's been writing 2 very, very good books, one of which is called Unconventional Success. The other one is called Pioneering Portfolio Management. We will link these under this video here. I would say especially Unconventional Success is a book that I've been recommending to all my interns over the years, all my university graduates, because I think it equips you with the best ways to understand portfolio building blocks and putting them together in the right way and ultimately succeed in financial markets. Yeah, he passed away, unfortunately, on the 5th of May, way too soon. But I guess we can honor him by listening to his advice, heeding his advice, which most of all, I think is also important for a lot of investors, is to say that the longer you invest, the more equity-like your investments should be. And for example, he changed the endowment of Yale University from the traditional 60-40 model, that means just buying 60% equities and 40% bonds, into more long-term, also partially illiquid equity investments. Whilst this is not easy to replicate for individual investors, you can at least have a hard think about when you need what kind of money, and often enough the answer is I don't need it for a long time. And if that is your answer, then dare to put more equities in your portfolios. I see time and again that a lot of investors are a little bit shy of the equity markets. They wonder whether it's still the right time because equities may have done so well. Sometimes family members have bad experiences with equities. But I can honestly say a highly diversified portfolio of quality stocks will do a lot for your personal wealth. You then naturally have to combine it with quality bonds. But the ratios should always be a function of your investment time horizon. Well, that leaves me with the message that I would be very happy if you spend time reading our quarterly reflections document. A lot of good intentions and a lot of good ideas have gone into it. Again, we will also link it under the video. You can also find it on the website of Das Family Office. And if you found this video useful, please like it, subscribe to it, and maybe also recommend it to other people that you think could benefit from our ideas. And then obviously also the happy clients of Das Family Office. Think about other friends that could benefit from a dialogue with us and bring us in the picture. With that, I leave you to a good summer. Hopefully a lot of good news as regards the opening. Maybe we can travel again towards the end of the third quarter or the fourth quarter. But even if that's not going to happen, wish you good health and all the best for the second half of this year.